Hello everyone. Today I'm going over the extra problems of Chapter 8, Stocks Valuation. I start with the first question. The common stock of textile mills pays an annual dividend of $1.65 a share. The company has promised to maintain a constant dividend. This means that this 1.65, this is D, it's a constant dividend. How much are you willing to pay for one share? So what's the price, P0? If you want to earn a 12% annual return, so this is R equals 12%. So this is the case of stocks valuation with zero growth with a constant dividend. So the formula we apply is the following: P0 equals D divided by R. So this is 1.65 divided by 0.12, and the answer is 13.75. Now, for preferred stocks or for any stock with a constant dividend, it won't matter which price we are computing, whether this is the price P0, P1, P2, P4, P5, whatever, they are all going to be equal because I'm using the same dividend. So usually what happens, the only thing that will lead to a change in the price of the preferred stock is if there are changes in the discount rate or the required rate of return. Number 2, Miller Brothers Hardware paid an annual dividend of 1.15. So this is the thing that I want you always to do. I know now the exams are going to be online, but like usually when you are solving problems on stocks valuation, always be careful when you read the given. So here the company paid an annual dividend of 1.15 last month. So this means D0 equals 1.15. So it's important to know whether this is D0 or D1, because as I said before, this is one of the most common mistakes in stocks valuation. Today, the company announced that future dividends will be increasing by 2.6%. This is the growth rate G. So if you require a 12% rate of return, how much are you willing to pay to buy one share of the stock today? So this is a direct application of the constant growth model. So here P0 equals D1 divided by R minus the growth rate, or D0 into 1 plus the growth rate. And this is the form that I'm going to use because I have D0 and not D1. So this is equal to 1.15 into 1 plus the growth rate, so 1.026, divided by R, 0.12 minus 0.026, and the answer 12.55. So now the first two problems were direct application. Now for number 3, as you're going to see, I need to compute the price in year 1. In addition to that, I'm not going to buy one share of the stock, I'm going to buy 1,000 shares of the stock. So here we have upper crust bakers just paid an annual dividend of 2.8. So this is once again D0. It's expected to increase that amount by 4%. This is the growth rate G. Here you are planning to buy 1,000 shares of the stock next year. So you're going to buy 1,000 shares of the stock in year 1. So buy 1,000 shares in year 1. How much should you expect to pay if the market rate of return on this type of security is 11.5%? So this is R. So if I want to draw the timeline, I'm going to buy the 1,000 shares here in year 1. So I'll end up paying the price P1 per share. Now, there are two ways to compute P1. I can either say that P1 equals D2 divided by R minus the growth rate, or I can compute P0, which is D0 into 1 plus the growth rate divided by R minus the growth rate. Once I get P0, I can compute P1, which is like the future value of P0 after one period or 1 year. So P1 equals P0 into 1 plus the growth rate. So either method, I will get the same value for P1. Here I will apply the first approach or the first formula. So D2 is mainly D0 1.15 times 1 plus the growth rate. Excuse me, this is 2.8. 1.15 was from the previous problem. So this is 2.8 times 1.04 divided by 0.115 minus 0.04, and the answer here is 40.38. So this is the price per share. Because I'm buying 1,000 shares, the amount that I need to pay after 1 year is 1,000 times 40.38. So this is $40,380. Now problem number 4. The common stock of auto deliveries sells for 28.16. So the 28.16, this is P0. The stock is expected to pay 1.35 per share next year. So here, because I have next year, this is D1, 1.35. The firm has established a pattern of increasing dividends by 3% annually. The growth rate is 3%. And here I need to compute the market rate of return R. Now, R equals D1 divided by P0. This is what I call the dividend yield, plus the growth rate G. The growth rate G, this is my capital gain yield, because as dividends are growing at a constant growth rate G, at the same time, the price will be growing at that same growth rate G. So now, R equals 1.35 divided by 28.16 plus 0.03, and the answer is 7.79%. Number 5. The current dividend yield is 2.5%. So this is dy 2.5. The company just paid a 1.48 annual dividend. This is D0. And announced plans to pay 1.54 next year. So this is D1. The dividend growth rate is expected to remain constant. What's the required rate of return on this stock? Now, whenever D0 and D1 are both given and the same problem, this means that you should use that information to compute the growth rate. So this is 1.48. This is 1.54. So because D1 equals D0 into 1 plus the growth rate equals D1 divided by D0 minus 1. So the growth rate is 1.54 divided by 1.48 minus 1. So I have 4.05%. So now to compute R equals the dividend yield 2.5 plus the growth rate 4.05%, and the answer is 6.55%. Number 6, Great Lakes Healthcare offers an expected total return of 9.2%. This is R. The last annual dividend was 2.1, so this is D0. Dividends increase at a constant rate of 2.6%. This is the growth rate G. I need to find the dividend yield. Now, there are two formulas to find the dividend yield. The first formula is D1 divided by P0. However, in this problem, I do not have the price. I do not have D1, although I can easily compute D1. The second formula to compute the dividend yield is that the dividend yield is equal to R minus the growth rate, because remember, R equals D1 divided by P0, which is the dividend yield, plus the growth rate. So rearranging the formula, I can say that dividend yield equals R minus G. I have both values, so I can say that dy equals 9.2% minus 2.6. So the dividend yield is equal to 6.6%. Now for number 7, I have a stock selling for $38, pays an annual dividend that increases by 3%. So this is the growth rate G. The market rate of return is 8.2%. What's the amount of the last dividend paid? I need to find D0. So applying the formula with the constant growth model, P0 equals D0 into 1 plus the growth rate divided by R minus G. So the price 38 equals D0 times 1 plus 0.03%, so 1.03, divided by R 8.2%, so 0.082 minus 0.03. So in this case, 1.03 D0 equals 38 times 0.052 D0 equals this product divided by 1.03, and the answer is $1.92. Now I move to number 8. Electronics Incorporation common stock returned 22.68%. This is R. The dividend amount was $0.25 a share, which equated a dividend yield of 0.84%. So what was the rate of price appreciation for the year? To find the growth rate, I have multiple formulas. It's D1 divided by D0 minus 1, or P1 divided by P0 minus 1. However, the formula that I'm going to use in this situation is the following. The growth rate equals R minus the dividend yield. Because R and dividend yield are given, so I have 22.68% minus 0.84, and the answer is 21.84%. Number 9. A stock sells for 44.96 a share. The market rate of return is 12.8. The company just paid an annual dividend of 1.04. So D0 is 1.04. P0 is 44.96. R is 12.8%. I need to compute the growth rate. So in this case, I can say that the price P0 equals D0 into 1 plus G. So this is, if you want, like the fourth way or the fourth formula to compute G, divided by R minus the growth rate. So I have 44.96 equals 1.04 times 1 plus G divided by 0.128 minus G. So I have 44.96 times 0.128 minus 44.96 G. This is equal to 1.04 plus 1.04 G. So I have 1.04 plus 44.96. So I have 46 G equals 44.96 times 0.128. This is 5.75488 minus 1.04. So 4.71488. Growth rate equals that value divided by 46, and the answer is 10.25%. Now I move to number 10. Wintertime Adventures is going to pay an annual dividend of 2.86 on its common stock next year. So this is D1 equals 2.86. This year the company paid a dividend of 2.75. So this is D0. As I said before, you use this information to compute the growth rate. So it's 2.86 divided by 2.75 minus 1. This is for the growth rate. So 2.86 divided by 2.75 minus 1 equals 4%. The company will maintain a constant rate of growth dividend policy. What will one share of this common stock be worth 10 years from now? So I need to compute P10 given a rate of return of 11.7%. So if I draw the timeline, this is year 10, this is year 11. P10 equals D11 divided by R minus the growth rate. Now, I can say also that P10 equals D0 into 1 plus the growth rate to the power 11 divided by R minus the growth rate. Or I can say that P10 equals D1 into 1 plus the growth rate to the power 10 divided by R minus G. So whatever dividend I have, let's say I have D7. So if I have D7, I can say that P10 equals D7 into 1 plus the growth rate to the power 4 divided by R minus G. So the idea is that 7 plus 4 equals 11. 1 plus 10 equals 11. 0 plus 11 equals 11. So those two coefficients, their sum should be equal to 11 because I need the 11 to find P10. So here I can use this one or this one. So let's say I use D0. In this case, P10 equals 2.75 times 1.04 to the power 11 divided by R in this problem is 11.7%. So 0.117 minus 0.04, and the answer is 54.98. Okay, now for number 11. So this is the first application on the multi-stage growth model. So here, the company is planning on increasing its annual dividend by 15% a year for the next 2 years, and then decreasing the growth rate to 3.5% per year. That growth rate, the 3.5%, this is the growth rate that will last forever. The company just paid its annual dividend of 0.2, so this is D0. I need to find the value or the price if the rate of return equals 15.5%. So here, let's see what will happen with this type of problems. Here I already have the timeline for problem 11. So here I have a dividend D0 equals to 0.2, or the discount rate is 15.5%. Whenever I have a multi-stage growth model, the first step is to compute each and every dividend, like I'll compute D1, D2, D3, and so on, till I get to the first dividend at the constant growth rate. The constant growth rate is the 3.5% because this is the growth rate that will last forever. So in this case, I need to compute D1, D2, and D3. I will stop at D3 because this is the first dividend at the constant growth rate of 3.5%. So here I have the calculation for D1, D2, and D3. D1 is D0 into 1 plus 15%. So D1 is 23 cents. D2 is D1 times 1.15 once again, because I have this growth rate of 15% over the course of 2 years. So D2 is 0.2645. Finally, D3 equals D2 into 1 plus G2, which is 1.035. And D3 in this case is around 0.27 cents. Now for the second step, I move back 1 year and I compute P2. So I compute the price in the previous year. So the last dividend I've computed was for year 3. I go back now 1 year to year 2 and I compute the price in that year. Because now for P2, I can apply the constant growth model formula. I can say that P2 equals D3 divided by R minus G2. So 0.273758 divided by 0.155 minus 0.035. So computing the price in year 2, I have 2.281317. This is the price P2. Now for the third step, I compute or I identify the cash flows that I have from that stock. So in year 1, I have a cash flow in year 1 of 23 cents. For year 2, the cash flow that I have for this year is D2 plus P2. So I add those two values together. So the cash flow in the second year is 2.545817. Now the fourth and final step, I use the cash flow function on my financial calculator. And remember, whenever you use the cash flow function, you need first to click on second and declare work. You have nothing for CF0. You have 23 cents for C01, enter, down arrow. The frequency is 1. Now for C02, you have 2.545817, enter, down arrow. I go to NPV. I have 15.5, and remember here you enter the discount rate as a percentage and not in its decimal form. You click on enter, down arrow, compute. So the price P0 is equal to $2.1. So this is for number 11. So now if I go back to problem number 12, so now I have KL Airlines paid an annual dividend of 1.42 a share last month. This is D0. The company is planning on paying 1.5, 1.7, 1.8 a share over the next 3 years. After that, the company will maintain a constant dividend of $2 per share per year. So I need to find the price per share if the rate of return is 10.5%. So also here I've prepared the timeline. And here, as you can see, I do not need to do that first step because dividends are already given. So I already have D1, D2, D3, and D4. So now I move directly to the second step. So whenever you have a constant growth or a constant dividend, because remember, when you have a constant dividend, this means that you have a constant growth rate now of 0%. So because I have D4, the first constant dividend, I can compute P3, where P3 is equal to 2 divided by R 0.105. So the price in this case is equal to 19.05. So this is the price P3. Now for the third step, I identify the cash flows that I have. For the first year, I have 1.5. The second year, I have 1.75. And finally, for the third year, I have 19.05 plus 1.8. So 21.85. Now I use the cash flow function. After clearing work, I have 0 for CF0, 1.5 for C01, enter down arrow, 1.75 for C02, and for C03 I have 21.85, enter down arrow. I move to NPV, 10.5, this is my discount rate, enter down arrow, and then I compute the price. So it turned here that I've made a mistake in computing the cash flow in year 3. This should be 20.85. So quickly I go to cash flow. I go to C03 and I enter 20.85, enter down arrow. Then I move to NPV and I compute the value. P0 equals 18.24. So now for number 13. So Beatrice Markets is expecting a period of intense growth and has decided to retain most of its earnings to help finance that growth. Therefore, it's going to reduce its annual dividend. So here, because I have reduced the annual dividend by 30%, this means the growth rate equals minus 30% over 2 years. After that, it will maintain a constant dividend of $2.5 a share. The company just paid 3.6 as an annual dividend, so this is D0. So I need to find the market value if the rate of return is 14.5%. So here I have the timeline for that problem. And this is, by the way, a rare case where you see a company reducing its annual dividend. And this is not a case that you will see on any exam. So now I have the discount rate R is 14.5%. D0 is $3.6. I start by computing D1 and D2 because starting from year 3, I have a constant dividend of 2.5. D1 is equal to D0 into 1 plus the growth rate, which is minus 30%. So I will have 3.6 times 0.7, 2.52, this is D1. Then D2 is 2.52 times 1 minus 0.3. So I have 1.764, this is D2. Now, starting from year 3, I have a constant dividend. So now I can compute the price P2. which is 2.5 divided by 0.145. So 2.5 divided by 0.145, I have 17.241379. This is the price P2. I identify the cash flows. So I have in year 1 2.52. In year 2 I have D2 plus P2. So I add those two values. I have 19.005379. Now I use the cash flow function. I clear the previous entries. C0 is 2.52. Enter, down arrow. C02 is 19.005379. Enter, down arrow. Now I move to NPV. 14.5. Enter, down arrow. And I compute the price P0, $16.7. Finally, problem number 14, which is maybe the simplest problem. The preferred stock of rail lines pays an annual dividend of 7.5, so this is D, and sells for 59.7. This is P0. I need to find the rate of return on this security. In this case, R equals D divided by P0. Because remember, for preferred stocks, the growth rate is equal to 0%. So still, if I'm applying the main formula plus G is equal to 0, so there's nothing here. So R equals D 7.5 divided by 59.7, and the answer is 12.56%.